So good morning, good afternoon, everyone, sorry. So I will talk about survival in the French industry, and I will compare cooperatives and cooperation. So this is the first empirical paper of my thesis, written with Paul Amadieu and Patrick Sentis. The outline will be classic, and I think I will be quick on the theoretical background and hypothesis to focus on results and discussion. So why the wine industry? So it's obvious, good people study wine, but wine industry because this is an industry that knew a lot of shifts and mutation from decades, so I think it's pertinent to study the adaptability of companies on such a context. And it's pertinent to compare cooperatives and corporations because cooperatives represent nearly the half of the French wine production, so they deserve interest. And they have a different business model, so this is important to compare the two kinds of cooperation and cooperatives. And our question is, are wine cooperatives better able to adapt to their environment? So our hypothesis, if we look at the literature, the common view, the classical view of cooperative is that they are inefficient. But if we look at the matter more closely, we can see that they were able to innovate in their organizational structure in order to evolve to a new model of governance, new model of ownership. So in fact, they are able to adapt to their environment and to evolve in their model. Most important, their association of people, so social capital is a competitive advantage, and particularly in time of crisis. So they will be maybe better able to resist. And until then, previous studies about cooperative performance was about traditional performance and financial performance, but cooperatives do not aim to maximize profits. And in our study with survival analysis, we are more interested in long-term performance and capacity to adapt. So our first hypothesis is that French wine cooperatives will have a better survival rate than corporations. The second hypothesis is about the determinants of this survival. And the common view is that the more market-oriented you are, the more effort in intangible and expert you do, the more successful you will be. But we have to admit that cooperatives are rather member-oriented than market-oriented, and that they are, in general, in France, they're engaged in expert and intangible effort. So there is a kind of paradox, because I just said before that we expect that cooperative will survive better, but obviously they are not performant in the key factor of success. And our hypothesis is that maybe cooperative will have specific features that help them to survive over time, and maybe it will be the price paid to producers that will be a variable of adjustment. So our second hypothesis is that determinants of survival will be different from cooperatives and corporations. So our sample, let's compare the corporation and cooperatives, French wine corporation and cooperatives, and we studied demises between 2008 and 2015, and we have about 50 demises. So the methodology, we will be interested in the survival probability, of course, or the hazard rate, which is the exact opposite. And we will use principally the survival analysis, and the main interest of this approach is that you are interested not only on the event, that is, if the firm disappears or not, but we also we are interested in the time before the event occurs. So we will use principally two models. And the first one is the Kaplan-Meier estimator, and will allow us to compare two groups of people and to compare the survival probability of two groups, so corporation, of course, and cooperatives again. And the second model will allow us to take into account, the impact of some variables on the hazard rate of cooperatives and corporations. So in fact, the objective is to see if ownership structure have an impact on survival, that is being a cooperating allow you to survive better, even in presence of control variables which are there. So now, most important, the results. So we see in this graphics that in each point of time, the survival probability of cooperatives is higher than the survival probability of corporation, and the difference is statistically different and significant, Then the Cox model. So we run the same model, but with control variables. And we see that in each case, being a cooperative is significant. There is a negative coefficient because we are interested on the hazard rate. But we see that on the last model, the results are only significant at the 10%. So we see, maybe we think this is because we didn't take into account the different causes of demise. In our sample, some firms disappear because of dissolution, some firms because of liquidation or merger. So we could have implemented a competing risk model. But in fact, all the cooperatives disappear or quasi exclusively because of mergers. So it would be pertinent to have a competing risk model. And when you disappear because of mergers, it can be a defensive merger because you're in difficulty, or an offensive merger. So in fact, we use another methodology, and we built a score able to discriminate in our sample firms that disappear because of economic and financial difficulties and the others. And we kept in our sample only the firm, cooperative or corporation, that disappear because of economic and financial difficulties, and rerun the analysis. And this time again, being a cooperative is a main driver of survival, and the significant are better. The significance is better. So we can say that our first hypothesis, French wine cooperatives, have better survival rates than cooperation, is validated. So now we'll be interested in the determinants of survival, and we run two models, one for corporations, one for cooperatives. And what we see is that the determinants of survival are clearly different for corporations and cooperatives. As we don't have time, I will be just only interested in cooperatives results. And we see one surprising result. This is the more you're expert for a cooperative, the more probability you have to die, to disappear, because this is a model, the Cox model. Maybe this is because cooperatives are not financially strong enough to support some expert investment, or maybe because they don't invest enough. They invest in expert, but not enough, so the cost is too high and there is not enough return. But which is important for our studies is that none of the traditional financial criteria are pertinent for the survival of cooperative. You see, financial leverage, return on asset. This doesn't matter. Which is important is the price paid to members. So in fact, cooperatives seems to have really a different objective, and which is main driver of survival is the price paid to members. So we'll go a little further, and we will try to explain why cooperative will survive longer. And our hypothesis is that cooperative have to have an objective is to maximize the members' remuneration. So in fact, the variable of adjustment in case of business fluctuation will be the remuneration of members, which is here the raw material purchases. And if our hypothesis is true, we build a ratio of standard deviation of raw material purchase to standard deviation of sales. If cooperative aim to maximize the members' remuneration and use the raw material purchases as a variable of adjustment, this ratio will be close to 1 for cooperatives and close to alpha for corporations. So we test this hypothesis, and we see that, yes, this ratio is higher for cooperatives and corporations. So we can say that, indeed, cooperatives aim to maximize the member remuneration, but this is not exactly new. Which is important for us is that surviving cooperative use this mechanism to survive, because member will absorb the shock. So our second hypothesis is validated. Cooperatives have different determinants of survival, and our explanation is that they shift fluctuation of their environment to their member. Members will absorb the losses. So in this paper, we use an original methodology, which is survival analysis, to provide a new evidence on cooperatives. The first one is that we propose a new measure of performance, long-term performance, and we see that cooperatives survive longer than corporation, and this is the first evidence in the French wine industry. We give another empirical proof of the inappropriateness of the traditional financial criteria for studying cooperative, because they aim to maximize members' remuneration, not shareholders' remunerations. And we propose a beginning of explanation of these mechanisms of the better survival rate of cooperatives, that is, they shift fluctuation of their environment to their members. Of course, there is some limitation and some path for further research. The first one, and the most important one maybe, is that we said that the impact of intangible investment was really important for cooperatives, but we were not able to measure it in the study. So we hope to be able to do this in some further studies for the thesis. Another problem is the left truncated, right censored data. It sounds like evil, but in fact it's not a big deal. It just, we studied firms who disappear between 2008, sampling date, and 2015. So the firms that didn't survive sufficiently longer to be sampled were not observed. You know, the T1 not observed firm. So one solution is to run some cohort studies with more data. So I will do this in the next papers. And The last limit is in terms of allocation of value between firm and members. My colleague just said that. If we give all the value created for members when times are good, and if members absorb all the losses when times are bad, maybe this is not optimal. Maybe we have to keep some money in the cooperative to make some investment and to ensure the sustainability of the business and give an optimal part to the members. So maybe we have to find this optimal allocation of value for cooperatives to survive over time. So thank you for your attention.